So I guess I will get started. And this is a discussion on the growing importance of ESG investments, environment, social, and governance awareness, with focus on the retirement and mutual fund space. And so it all started out with a project that a student Santhoshi was doing for me, and it developed into this particular discussion. So, uh, these are very important factors, and we do in fact demonstrate that such concerns have become a key feature in the mutual fund and retirement space. So there is also a philosophical debate between adherents to shareholder rights and proponents of shareholder advocacy, between maximizing corporate profits and maximizing societal welfare. So, as a matter of fact, our previous speaker just did touch upon these issues. But many publicly traded U.S. companies have focused increasingly on delivering profits to shareholders and beating quarterly targets. And while they, in fact, ignore issues such as stagnant wages and mounting debt and their the positions of their lower class and lower and middle class employees. So shareholder primacy has become, pretty much an American norm, but the shareholders themselves have been changing their priorities to, ESG factors in their investment. So we can't say right off the top bat, that something is right and something is wrong. But, how can firms, in fact, start placating all kinds of different shareholders? And in fact, the issue also is investment managers maintaining competitive performance if they're integrating criteria that don't have a solid economic basis. So there is definitely a lot of need for debate. And generally speaking, if you look at some of the statistics, the World Health Organization has estimated that something like 4.6 million deaths are directly related to air pollution and each year. And so this is a very high number. So obviously we just can't rest on some of this discussion. And in fact, when we look at the mutual fund fact sheets, what we are looking at is, how do we incorporate some of this ESG analysis into our discussion as well. So there's obviously the notion that we may have forgotten some components of this. So this is a rather lengthy presentation, so I will not be able to get into all of this discussion. And but this will just guide you in, as to the presentation. And there is a rather large appendix as well, which gets into more greater detail. So let's start out with our discussion: ESG integration in mutual funds. Definitely, when you look at this kind of a graph, you can see that numbers in ESG have definitely gone up. But if you look at this, in mutual fund analysis and the asset levels, you can see that these have continued to evolve. And so there is a lot of interest. And generally speaking, although 2018 was not a good year, it seems that 2020 has shown some more interest in ESG funds. And so, and I'm referring to a Deutsche Bank report, which did show that during the third quarter of this year, on the heels of the pandemic, there was a lot of inflows into ESG funds. So if you look at some of these discussions, you can see that there are, something like 182 ETFs that incorporate ESG into their investment strategies, and 59% of ESG funds were launched in 2018, 2019. So these are interesting facts, but the question is that, how do we look at ESG in terms of, our rating scales and so on? So this is an again, just to show you the ESG scales. So you can focus on different elements over here, but the idea is that, you've got the ESG scale in terms of vice, which is, I guess, tobacco, alcohol, and so on. And then you have the impact on this particular scale. So those are funds that would seek to forcibly generate positive social and or environmental impact alongside a financial return. So in this particular side, the outlook for ESG adoption in the retirement plans, and we all are subject to it. So is firmly positive. So several drivers in market demand, regulation, and market factors appear to, in fact, support further growth of ESG assets going forward. So if you look at it, in from a competitive perspective, they are, efficient. Where markets are efficient, vice agnostic, ESG aware categories eventually converge to the same portfolio. So there may be some lip service going on over here. Only ESG focused and impact strategies are really differentiated, because they're trying to accomplish something outside of performance. And in doing so, a dividing line has been crossed. So bad actors are removed from the investment universe, and ESG focused manager will not invest in them, no matter how cheap they might be. So this can be criticized because eventually, you're leaving money on the table. Or, if you compare yourself to other portfolio managers who maintain different style purity and refuse to invest in off benchmark kind of investments. So there's an issue over here that, what are investment managers, what are they exactly hired to do by the investors? So we have, different issues that we want to keep in mind as well. So as a matter of fact, moving on the discussion, you can see that over here, ESG adoption drivers. So ESG adoption drivers, of course, the demand is going to determine how, the different aspects are going to come into play. So generally speaking, if you look at this particular one, women, millennials, and Gen X, these are the groups that have been a little bit more active. And so the outlook for ESG adoption in retirement plans remains firmly positive. But generally speaking, the other factors, if you're looking at them, market demand, regulation, they also tend to support growth of ESG related assets going forward. So generally speaking, this is the graph over here indicates, how the adoption has been proceeding. And like I said, in the heels of the pandemic, we don't have that full complete data, but generally speaking, this has increased. But for our purposes, we also need to examine that, how is some of this developing. And so moving to the next slide over here, we can talk in terms of ESG investment approaches. So generally speaking, there can be very different approaches, severe to to limited. All right. So ESG investment, to make a good point, does not come as a packaged product, or is upstraight, in a standard or straightforward approach. Even the most simple form, a negative or exclusionary screen, requires human judgment to a point. So there are many approaches, some of which can be mixed and matched, and even two strategies employing the same design are likely to go about in quite different ways, with stark differences in the resulting portfolio holdings and their weights. So the most prevalent approach after, some of this exclusionary screening is ESG integration. So it's also a faster growing approach and basically describes systematic and explicit inclusion of ESG risks and opportunities into the process of financial analysis, which can include adjusting valuations based on ESG related risks and opportunities, and identifying and measuring the impact of off-balance sheet ESG related assets and liabilities. So this can be a robust bottoms-up approach to a lighter factor-oriented integration. So examples of factor-oriented integration, it could be a style or growth, value, or volatility. So I think, when we look at some of our plans, we can see some of this discussion as well. So these are just the different gradations that we can think about. And so, in terms of our ESG criticism, um, what is exactly going on? And so, when we look at some of this discussion, is there a lot of greenwashing, as we can call it, or lip service of funds without fundamental changes? So, in other words, a lot of funds will pretend that they are very ESG sensitive, but it's a problem that we can observe over here. So, not just philosophically, but how ESG is being actually implemented in practice. So there is no, real concrete reason why refusing to invest in a company would necessarily have a material impact. So if markets are efficient, stock prices will continue to reflect intrinsic value and risks the same way as they do today. So you're not actively punishing a company that, the same way you could by boycotting their products and services. So secondly, index and target funds have put pressure on active investment managers who have been suffering from net outflows, in the prior time periods. Some active managers may, in fact, see this ESG as a means to stem the loss of assets and resist some downward pressures on fees. So ESG investors also don't want the same thing, and analysts may, in fact, end up disagreeing on ESG rating of a company for a wide variety of reasons. In fact, there's a lot of different ratings that we're going to discuss in a moment. So, generally speaking, you can end up alienating some potential investors as well. So, some environmentally focused ESG funds, for example, nuclear energy due to potential for radioactive contamination, while others may overweight it as a contributor to cleaner air. So, you can have different strategies over here. And one analyst may reward a company for below industry carbon emissions, and another analyst may, in fact, penalize the same company for outsourcing the most carbon intensive component of its production process. So investor values often conflict, and so do analyst opinions. So the argument that uh, ESG criteria are aligned with superior risk-adjusted performance can't always be true if ESG means opposite things to different people. So many of the arguments, compelling ESG investment will become more persuasive if they are proven out by mature investment funds. So right now, for example, ESG is unsettled territory. So we acknowledge that, and it's still developing, and seeking out a consensus around which form to standardize. The question is that, how do we see the potential benefits from becoming early adopters that would outweigh the potential risks? So, just going on with this particular discussion, ESG fact and fiction. Numbers, some of these numbers may be dramatically inflated. So if you look at some of this discussion, these are different options are available across asset classes. But I also have to remind us all, that we do have some inertia in our investments. So if you look at our TIA, our other holdings in our 401k plans, we may not be such active managers, and specifically going in for ESG components as well. So, it's very trendy for investment managers to talk about ESG, but if over here we in fact do not see that matched by a lot of money flowing into ESG. So this gives us the record over here in this particular graph. So you can see asset managers, institutional investors, they have in fact grown, but the question is that, if even while they're getting more assets, they appear to be staking out ESG territories with supply that outpaces demand. So large numbers are touted about how ESG has taken over, but on closer inspection, the truth is that these numbers are dramatically inflated and overstate the expanding but still minor role of ESG investments in financial markets. So, as a matter of fact, moving on to this particular slide, and I'm sorry for rushing through, but we have limited time today. But this particular slide discusses the inclusion of ESG in corporate retirement plans. And more ESG options are available for sure. And you can check your TIA as well. But low enrollment, in fact, has been seen. So basically, this depicts that, slide from slide shows that select surveys and notably, take up is still pretty low. So when we look at some of the 401k plan survey data, we see that only about 4% of plans, in fact, offer an ESG investment option. And when such an option is offered, it tends to attract less than 1% of plan assets. So low take up is, in fact, a strike against ESG, but not a valid reason to rule out ESG itself. So if that was the case, most fixed income options would not be offered. So I'm just quoting Vanguard. Tips and socially responsible equity funds both attract around 4% of plan participants um, who are offered this particular choice. And as a matter of fact, in some of our defined contribution plans, it could be, tips is in fact higher, and they do attract older participants with higher balances. And in fact, if you look at the data, the ESG funds are more popular with younger participants who have lower balances. So the question then, just from a standpoint, and this is pretty funny, is uh, oops, how strong do you take your ESG? So as a matter of fact, this is kind of gives you a little bit of a rating scale, and in terms of what your appetite is. So ESG aware funds, I guess that is the weak one over here. So that's your coffee mug, so to speak, and it's basically not that heavy on ESG related issues. So ESG focused, I guess that would be your medium strength coffee. And that would in fact demonstrate a commitment to ESG investment. And you in fact do have naming and marketing of their funds. So, avoid certain companies regardless of how cheap they might be. And impact funds, of course, the strongest dose of coffee, which would in fact narrow ESG goals and actively strive to see that the goal is in fact achieved. So these are bold single origin brews, so to speak, that you do have to have an acquired taste. So this is a premium product and towards heading towards a premium price tag, but they have a devoted following. So generally speaking, so this is our criteria that we can see in some of this space as well. So there are issues that arise over here because it is a personal choice as well, and some of us may believe that excessive focus on ESG may in fact give us lower returns. So let's take a look at some of these issues as well. So ESG rating differences, if you look at some of the data, and in fact, you can go into Yahoo Finance, and there is something which is known as sustainability. So you can look at different companies and the ESG scoring in some of the three different criteria. So this just lists some of the providers: Sustainalytics, Asset4, which is now Refinitiv, KLD, etc. And the rating agencies, the credit rating agencies, have also got very heavily involved in some of this discussion. And so, if you look at this correlation matrix, you can see that the correlations are pretty low across different providers. And as a matter of fact, it's if you look at the credit rating agencies, their ESG scoring is much more correlated. So this just is an indication that you can in fact find a great diversity of opinion as well. So measurement, as stated over here, explains 50.1% of total differences, and some attributes, using different indicators. So you can have a judgment call over here. And this is something that you can see that there could be considerable conflicts in terms of the ratings. So, as a matter of fact, we can just move right along. ESG rating comparisons. This is just sort of giving you an idea about some of these companies that are involved. So, obviously, some of these companies have not done very well on the ESG rating scale, but obviously there are some other issues that come up from scores from MSCI, Sustainalytics, and Refinitiv. They look very different from each other and from participant expectations. So I guess your priors, in fact, come into play, and could be a little surprising um, that Tesla is the worst of three companies in terms of ESG, while MSCI ranks it highest overall. So bad news for Tesla, but whenever we look at the companies, like I said, it's important to look at some of this discussion as well. So this is just a quick comparisons, and in fact, when we look at our next couple of slides, did in fact look at results of three sets of analysis when we ran comparing ESG and non-ESG funds. So we looked at passively managed funds, where a manager offers both ESG and non-ESG funds that are otherwise comparable. We examined funds labeled as socially conscious from Morningstar, and which manages to self-identify for their funds and is indicated of ESG awareness. Third and final analysis looked at what we consider to be ESG focused funds. And as a matter of fact, funds that include a clear ESG keyword in their name and otherwise present present and market themselves as ESG. So if you look at some of this, you can see from here that the findings are similar and mostly in agreement. In all cases, expense ratios tend to be higher with ESG funds. ESG funds also demonstrate a growth bias and outperformance in the 3 to 6 year frame, but longer term underperformance compared to non-ESG. But I can also cite uh, a Deutsche Bank report that did a more global comparisons, and they found that some of these performance measures did in fact improve during the pandemic, and particularly during the third quarter of the year. So as a matter of fact, if you look at, I'll just skip over in view of time, ESG performance literature survey. I guess we can fall back on some of the articles that are cited also in the lists. Generally speaking, our overall analysis is that evidence is somewhat inconclusive, that ESG funds outperform, but again, to emphasize, recent evidence is showing improved performance. So this particular slide is just a robust way of pointing out, in fact, that there exists inconclusive evidence for the argument that ESG either outperforms or underperforms non-ESG investments. So that is not surprising at all, because of the simple reason that ESG itself has many interpretations and approaches. So the only tentative conclusion that we can really make is, in fact, that ESG adds a style tilt, partly growth, and that is bound to add some tracking error against non-ESG benchmarks. And also, funds do tend to have a higher expense ratio. But the point to note is, just because ESG funds exhibit these tendencies on average does not mean that we would necessarily be able to find an ESG fund that does not do so. So just to sort of conclude this particular segment, our findings do in fact indicate, and what we have highlighted, that there are challenges to adoption of ESG criteria by plan sponsors. And in addition to the legal and fiduciary issues, which is discussed in a paper by Sarah Burt, adoption is hindered by lack of standardization, weak public awareness, and what exactly defines an ESG investment. failure to attract significant assets when ESG options are added, questionable performance benefits, and often relatively higher fees, limited selection of established products, and a choice between ESG focused funds give in will satisfy only a narrow segment of participants. And ESG funds that attempt to appeal to a broader audience at the cost of potentially satisfying no one, you know, that's another thing to keep in mind. So generally speaking, and to close up this discussion, as with any potential addition to the lineup, if we do want to offer ESG participants in a 401k, it comes at the expense of costly shelf space. So not only does this leave less room for possibly more deserving type of fund, but it means we can reasonably offer a limited number of ESG options. So I'll close up my discussion at this particular point. I can see there are lots of chat issues, and generally speaking, that we're leaving the door open that ESG, are you satisfied with the same kind of fund? Is it fair to offer an environmentally friendly fund without offering a socially conscious one? Is it fair to force participants who just want the E or the S to in fact offer the G as well? So, so the question remains, and which ESG approach or approach to choose is a whole other discussion. So again, I just want to point out there is a large appendix and gives you greater details on stuff that you might want to know as well. All right, lots of issues, lots of questions. Okay. So shifting our thinking is compliance, or not. I guess that's something that is an individual choice to a large extent. And as a matter of fact, uh, I guess I really like Gerard's comment. As many say, the planet will be here. Is it humanity that will die? So, given what the World Bank reports and others in fact show, this is in fact a perfectly logical concern. So you can think about your own strategy as well, and and think about it in terms of how much you have managed your particular fund. And there is, I should point out, there is a great deal of inertia. We don't go into our funds all the time and keep on trying to tinker with our asset allocation. So I guess at this stage, anybody who wants to offer a comment is more than welcome to do so. I know there are very informed participants uh, over here. So Gerard, you had a comment? I guess you can just unmute yourself. Santhoshi, do you want to, I guess, just comment on anything? So the question that is being asked is, are you an ESG investor speaker? And the answer is no. I got involved in this particular topic, as I mentioned, ESG because of Santhoshi's Inuganty's project work, and then we developed this theme further. So yes, we do intend to work further in this. It has become a very important issue, and so definitely I may be speaking out more and more. But first, I got to go back and look at my own 401k allocations. So, and I suggest everybody do that as well. All right, I forgot to introduce myself right at the very beginning. I've been asking everybody to introduce themselves. I'm a professor of associate professor of finance and economics at Rutgers Business School. I also have a forecasting firm, so I do forecast a lot. And basically, so this all ties in with my finance interests in particular, but it also ties in with my economic interest. And I think one of the things that I intend to explore is country ratings on the ESG scale as well. So Piyushi, in fact, had a discussion of the company stuff, and it may be interesting to get involved into the country discussion as well. All right, we're kind of quite a bit over time. So this is interesting. I suppose any investors would be keen to set up their own fund. I think so. I think we can just check around, and definitely try to get some traction over there, But as I said, there are degrees of ESG funds, So Goldman Sachs put out a fund, for example, and that was what we call as greenwashing because none of their underlying portfolio had in fact changed. And so, as a matter of fact, we don't consider that to be serious business, We have to look more carefully at the funds that have in fact made better inroads and better traction. So you do have to do a lot of grunt work in terms of uh, assessing the honesty and integrity of different funds as well. All right, any other comments? Feel free to unmute yourself and come on board. Okay, so I guess I will close up shop over here. And of course, you're welcome to reach out later if you want to have any kind of a discussion.